Okay, it's time now to get down and dirty with the currencies. I bet you've all got some balance sheets and some P&Ls that are dependent on what's happening with currencies. And at the moment, with Trump on his Twitter feed and Kim Jong-un with his finger on buttons and things, it's always good to understand what's going on in the world and how that's affecting currencies. So please join with me in welcoming Phil Lynch. Phil, thank you very much for coming.
Thank you.
Let's grab a seat here and do something I enjoy doing, which is talking about currency and macroeconomics and what's happening in the world. But first, could you tell us a bit more about your company and how it operates and what you're doing there at EncoreFX?
Absolutely. Can everyone? Hello?
Yep, you should be. That's up. Yep.
There we go. Is that better?
Yes.
Fantastic. Hi, everyone. So EncoreFX, we're a foreign exchange business that helps businesses manage foreign exchange risk. We do that just like many of the other businesses, but I found it interesting listening before about how the business need for the customer is often the same, and the business need is managing risk. But where we do it a bit differently from the banks is not just by doing the FX contracts around your business risk, but actually helping you through the process of managing that risk as well, whether that's building a policy, finding the right product, or finding the right solution.
So that's excellent. So the markets have been all over the place, actually for 10 years, frankly. It's been quite. We started at the beginning of the day talking about how a week ago, 10 years ago, Northern Rock really started the global financial crisis. But we've also got other things happening here. Could you talk about what's driving the volatility at the moment in the market and talk about some of these extreme moves?
Sure thing. So there's probably been a couple of main drivers of the different moves in currency lately, and one of the big ones, surprisingly for some, has been the political environment, which is very topical, of course. But I'm sure you all remember back to the Brexit vote, and I'm sure you all remember back to the day that everyone said there's no way that they're going to vote to leave the EU. I remember that. And that was one of the most exciting days of my life, because when that did happen, despite some of the ramifications, which may not be so favourable, it was a busy day in currency, and for us, that's always a fun time to be
exciting.
Working
I
in
take
markets.
it you weren't long pound.
No. And we don't go long pound.
No.
We help businesses manage that underlying risk.
Right.
And the move on the pound was actually quite dramatic. It was against the greenback, the pound moved over 11% in just 2 days, and against the New Zealand dollar, it took 10 days to move more than 15%. So when we think about some of the people we've spoken to here today, I know that Orion were on stage earlier, and they mentioned that 7% of their business is domestic, 93% that means comes from overseas. That's a fair amount that comes from the UK that would have been impacted by that.
So we had some big political risk around Brexit and Trump. What's your feeling about the New Zealand election political risk?
Well, we certainly did have some big impacts from what Trump got up to, and there's just a little bit of a chart up on the screens here behind me which shows the US dollar index. So this is the value of the US dollar. Since Trump got elected until today, what you'll find is that the dollar did go higher initially. The US dollar did appreciate, it did quite well. People were quite upbeat about Trump moving into power, but that quickly turned, that quickly faded. He lost his congressional support and things turned around, and the US dollar has since been on a bit of a slippery slope. What we find interesting is it's often not what goes on in New Zealand that affects the value of the dollar, but what goes on overseas. But like you say, there's a lot going on in New Zealand politics that's coming up that could have a bigger impact on the New Zealand dollar.
So this is a really useful way to look at the three main players, the kingmaker, the potential queen, and the king, and what they might do for the Reserve Bank. So talk us through this.
Yep, absolutely. So this here just shows some of the decisions that the different potential governments are going to make around the RBNZ, or the Reserve Bank Act. And so both Bill English and Jacinda Ardern have signalled their plans to actually shift from a a single vote for a governor on monetary policy to having a committee to make these decisions. So at the moment in New Zealand, it's been made by a governor and not a whole committee, whereas elsewhere in the world, it's often done by a committee. Labor have also signalled that they want to add an employee mandate to the RBNZ Act. And this is important, which we'll get into later, because some of these things drive the value of the New Zealand dollar. Winston Peters has also indicated that he would like an employment mandate added. And interestingly, which I don't necessarily think is going to come into play, but Winston has also included a driver of actually having the RBNZ take into consideration the value of the exchange rate when making their decisions.
So let's say we have a change of government and it's Labor New Zealand First. They change the Reserve Bank Act to add employment, potentially foreign exchange to the Reserve Bank Act, maybe a new policy targets agreement and a new governor, because we've got to get a new governor by March.
That's
what
right.
could that mean for the New Zealand dollar over the next sort of year or two for our audience of people who are sitting on some New Zealand dollar risk?
Well, I hate to disappoint everyone, but in my own humble opinion, and I talk a bit later about who you should trust in giving opinions, but I don't think it's going to have too much of an impact on the value of the New Zealand dollar. The reality is this isn't going to be a Trump or a Brexit moment. There isn't that same ramifications for New Zealand. So I just don't think we're going to see the same sort of impact. Likely we're going to see either Labor or National leading the government, and so regardless of which camp you're in, they're probably going to take us on a fairly consistent course from largely from an economic point of view. But one of the things we've done is also compile just a little bit of an analysis on what happens under different governments. So I did find it quite interesting that we also have a little orange man as our election mascot, but
He hasn't got the hair though.
Hasn't got the same hair, no. But the reason why I wanted to share this chart with you today is it shows what the New Zealand dollar has done. So this is the New Zealand dollar versus the US dollar since back in the late 90s under the successive governments that have come in, colour-coded for your convenience there. And it also shows some percentage moves under those different governments. And so what you'll see is that in the very first, or the national government way back, down 27%. And most people would assume that perhaps, National would create a better environment for an economy, generally speaking, and actually lead to a stronger environment for interest rates to go up and so forth, and potentially drive the value of our currency higher. But it didn't turn out that way. And as you go across this, you'll see that there's actually no distinct pattern under any different National or Labor government that has eventuated. And the key reason for that is there's been too many international events. There's been too many things going on overseas outside of what we do that have been affecting it.
You could argue, though, that under both sets of governments there's been a significant structural shift higher in the New Zealand dollar.
Well, that's certainly something that has happened. There's been some underlying reasons for that shift higher as well, especially over this particular time frame that we're talking about. One of the things that we wanted to look at closely was some of the other drivers, which was the way that central banks operate and the way that impacts currency, because it's often more to do with what central banks are doing than what politics are doing. And central banks, as you will, I'm sure, all know, generally have a mandate to control inflation. And they need to control inflation to keep the economy ticking along and not have it go out of control like it has in the late 80s. And so they do that by changing the interest rates in each economy. And that forms a bit of a basis for interest rates markets right around the world. And so there's a couple of key players there, and I want to talk about a couple today: the Federal Reserve, the US Central Bank, as well as the RBNZ. And generally speaking, when we look at some of the statistics here, you'll see that inflation in New Zealand and the US is sitting okay, 1.7%. This is an annualised number. Unemployment, 4.8 and 4.4%. Things are going okay in our economy. And same with the US. They're starting to see signs of a recovery. And so what that means is there's added pressure on the reserve banks, the central banks, to start controlling that inflation. And so tightening cycles might emerge in the interest rates. And that's really important for currency especially the New Zealand dollar versus the US dollar. And one thing I wanted to highlight here was this key figure here, the New Zealand interest rates versus the US interest rates. And the reason that's important, I'm going to take you on a bit of a journey here, so try and stick with me as we go through this if you can. I know it's getting late in the day, but interest rates are a key driver of demand. It's a yield, essentially, for an international investor in currency. So what we're looking at here today is the difference between US interest rates and New Zealand interest rates. And I've got a little chart on the next screen here. Here we go. Which actually shows you the difference between New Zealand interest rates and US interest rates. And why I think this is important for the New Zealand dollar is because it's an indicator of demand for the New Zealand dollar. It's on the demand side of the New Zealand dollar. So the higher the interest rate that you can get for your New Zealand dollars, the more likely you are to buy them. It's just a greater return. And so this is something that forms a bit of a fundamental basis for that demand.
So why hasn't the New Zealand dollar fallen much further? It would suggest with that falling differential that it should be lower than that crazy high 72 cents it's at the moment.
Yeah, well, you're stealing my thunder, but that's totally fine. The peak, I'll just take you through a couple of these slides quickly.
Sure.
The peak was 6.25%. So imagine you're an investor, you've got US dollars, you buy New Zealand dollars, you get 6.25% return. This is what starts to fuel that demand for the New Zealand dollar. Once we overlay the New Zealand dollar exchange rate, you can see that it does largely, even though there is a little bit of a lag in the earlier years, it does largely follow the same course as this interest rate differential. This is this journey that we're taking you on here. Okay, so there was a little bit of a period where it didn't work out too well in terms of this pattern here, where it broke from that pattern. And that was when the Federal Reserve in the US began quantitative easing, so increasing their money supply. But once they stopped their quantitative easing program, you can see that that pattern returned pretty quickly. So I think this is a really interesting analysis for the New Zealand dollar, because we've found ourselves in a situation now where the interest rate differential is actually forecast to go below zero. So the Federal Reserve in the US are planning on raising their interest rates, and the RBNZ are being fairly stubborn in staying on hold, staying neutral. And the thing I wanted to point out here is the last time that the New Zealand dollar, US dollar, had higher interest rates than in New Zealand. And that was back in the year 2000. And you can see that the Kiwi quickly took quite a dive and was down at, for a while, under 40 cents. It went to 39 cents for a little while.
Woohoo! Any exporters in the audience?
So, yeah, look, I'm not purporting to say that this is where I think the New Zealand dollar is going to go next, but you do have a very distinct movement away from a very long-term trend here.
Why do you think there is that gap opened up? Is his name Donald?
Yeah, partly because of Donald, but there's also a bit of a disparity, I think, with what the Federal Reserve are saying they're going to do versus what markets believe that they will do. And so the market is a big beast. And sometimes there is a little bit of a lag in the way these things work as well.
So the other thing we haven't talked about is Kim Jong-un. Tell us about North Korea. What does that mean for people trying to think about international foreign exchange risk?
Yeah, well, that's probably going to be a bigger moment than Brexit. I couldn't tell you if something eventuated there, but there's really a key lesson in this for me, and that's not to try and forecast where the rates are going to go, but to expect the unexpected. And that's a real key message from us, at least, is to plan for the unexpected, because it's not necessarily what government is going to get in next, but the potential threat of a nuclear war with North Korea and the US is a real risk, and something that'll have a far more dramatic impact on our small economy at the corner of the world, just out of range of his missiles, thankfully.
And you thought our discussion about cybersecurity was depressing. That's right. So we've got Kim Jong-un, that's unsettling markets. So let's say you're a CFO, you're thinking, how do I plan, how do I manage this risk? What are the options here?
Yeah, well that's where we can help, and that's where we want to help anyone that might be wondering how to manage that risk. And I think the first thing for me is to not do nothing, not put your head in the sand and Very rarely do we see someone go through a process of assessing all of their risks that they face and then deciding that doing nothing is a good idea. There's usually some tools in place that can help you better manage that currency risk. It's probably better to understand, first of all, just the three different key types of risks that are faced. So one of them is transactional risk. That's a risk faced with either your imported goods or your international revenues. There's also translation risk. That's the risk for your balance sheet items. And there's also economic risk, which is a more broad risk. I just wanted to share a story really quickly about my brother, actually, because it's someone I can laugh at for making a bad FX decision.
That's all right. We've got cameras rolling. We'll send it straight to him.
Fantastic. So he bought a house last year, a house in Auckland. Cost him $1 million. And he actually lives in the UK, so there'll be certain people that don't want him buying houses over here, but he's a Kiwi that lives in the UK. He wants to move back here one day, so he decided this market's out of control, he'll buy the house. And I remember him telling me how proud he was of negotiating a really good deal with the bank. He managed to get an extra 0.75% off the advertised rate on his mortgage, and a similar story to what I hear every day when I'm talking to different businesses that are managing FX risk. I've negotiated a really good deal and really good rates, and then I say, okay, well, what do you do about the FX risk? And of course, my brother's case, that was right before Brexit, and he's now paying an extra 15% for the cost of his mortgage.
Yikes.
So there are things to do, and when it comes to managing risk, it's really, for us, it's about using a best practice approach or looking at an FX hedging cycle. And so the very first step to this is identifying your FX risks. So what is it in your business? Is it the revenues? Is it your cost of goods sold? Is it a balance sheet item? Is it an investment you've got overseas? So what is it? Where do your risks come from? And then it's about setting your risk management objectives. So I'm going to skip through to some of these next slides here because I'm fast tracking a little bit. But so setting your risk management objectives. So one of the first things to do is think about, well, why do you manage risk? And I don't think many businesses put enough thought into this process. I mean, obviously people want to mitigate risk. They want to protect profit margins. The CFOs of the listed larger companies have calls that they have to make, and they have to continually promise increased profits to their investors, so they're looking for stability. So these things all drive different parts of an FX strategy. And so what we try and do is we try and get all of these different objectives together, because that will then determine what your plan or policy will look like. And one of the key steps for me in any good FX risk management approach is actually creating a written plan. And it's amazing to me that there's a number of businesses that won't have a written plan. And I think the audience today is more likely to have a number of written plans in their groups. But having a written plan will do a lot for you. And if you ever want to learn what should be in your written plan or have a bit of a review of that, feel free to check in with us, because these are just some of the things that should be in there. And we probably don't have time to go through all of them today. But I think probably one of the key reasons for a written plan is that it puts everyone on the same page. If a plan is signed off by the board and agreed by the CFO and then executed by the finance team, it creates an environment where everyone's on the same page. And too often what we see is the director on the board who sits in the corner who has a mate that told him where the exchange rate's going to go.
Yikes, yep.
And FX decisions are then done because he had a mate that he went fishing with on the weekend and said the rate's going to go here. Or you listen to someone like me and you say, oh, geez, that guy said the rate's going to go down to 39 cents again. Well, that's not what we're saying. What we're saying is that there are risks out there, and having a plan, having a process to manage that risk is really important.
So what you're saying is don't ask your Uber driver.
Don't ask your Uber driver,
No, okay.
And be wary what your foreign exchange dealer says as well. Follow your plan.
Yep.
Get a good plan in place.
So got any tips and tricks for thinking about foreign exchange?
Yes, absolutely. So there are a few more steps to the cycle there as well, but if you want to find out more about them, come and see us afterwards. The tips and tricks from me is don't put it in the too hard basket. Don't be like my brother. Don't miss out on the 15% loss for the 0.75% gain. It's really not that hard. So talk to someone like us about putting together a good process for that. if you've got your good process, feel free to get a review of it. Let policy drive your FX decisions. So this is what I was saying before. Too often decisions are driven either by emotion, the director in the corner of the room, or somebody else. Don't let that be the case. Make sure your policy drives your decisions, and that'll help you achieve your objectives of your policy. Ensuring your policy has hedge ratios and timeframes listed. So generally the way a good policy will work is it'll include forecasted transactions, that might be out 12 months, and then you'll have associated with that some sort of hedge ratio. So of those forecasted transactions, let's just take export earnings for instance. You might have $5 million a month of revenue in US dollars. What percentage of that do you hedge? What percentage of that do you take contracts for to give you that certainty? And that all stems from that initial analysis that you do in this risk management cycle.
So, we've got an election coming in 9 days. Mm-hmm. Where do you think the New Zealand US dollar rate is going to be after that election?
Well, I've got my own ideas, but...
Go on, you can tell us.
Well, look, I think possibly the New Zealand dollar could be in for a little bit of a dive, and I am going to subscribe to my own analysis that I put together today. Yep. Not so much because of the New Zealand election results, but because I think perhaps it's a little bit, the Kiwi strength is a little bit overdone in the economic environment. But what we absolutely don't want to do is trust me today and make our decisions because of what one guy said. But we do want to ask you as well. So some of you would have done this already, but what we're trying to do today is put together a bit of a CFO's view of where the New Zealand dollar will be after the election. So if you do have time, please do swing by our stall after the next coffee, or during the next coffee break. We've got a couple of computers where you can enter your details. You just need to put in your name, your company, your email, where the New Zealand dollar is going to go, and your internet banking password. And we'll publish those later. And there is a prize up for grabs.
That's where you make some real money. That's right. And then put it all on the dark web. Hey, thank you very much. That's a fantastic lap through the world of foreign exchange and what's happening. Please join with me in thanking Phil Lynch from EncoreFX.